All right, give it a set. There we go. All right, folks, thank you for that. Apparently, I am the slow one on a Monday. Um, so we'll get this started. Hey, good morning, everyone. My name is Frank Chistalti with AVO MedTech, and I so appreciate you spending a little bit of your Monday morning with us today. I'm going to turn it over to Max Rosen from Bernstein to introduce today's session. As you have questions throughout, throw them in the chat. We'll be watching, and we'll bring them into the discussion. And with that, Max, over to you.
Thank you, Frank, and good morning, everyone. I appreciate you all joining us bright and early on a Monday. So my name is Max Rosen. I'm a principal and senior wealth advisor here at Bernstein Private Wealth Management. And in a moment, I will turn it over to our colleague, Bob Dietz, who serves as a national managing director of tax strategies here at Bernstein. I just wanted to give you a quick overview of who we are, given that we're a name that rarely is known in the industry. And so Bob just put up a slide that gives you a very quick overview of our firm. So we're large in scale. We manage over $800 billion. We're global in our footprint in 27 countries. I think that the biggest thing here as a private wealth management firm is that 100% of our revenue comes from investment management and investment advice. And the investment advice piece is why we're really here today and why we partnered with Frank on this event. We serve as the largest research organization on Wall Street, and a huge portion of that is spent working with entrepreneurs, and especially in the Midwest with med tech and med device founders, to help them understand the financial side of things and how it will impact their ownership stake in their business. And so it's working with founders and their professional networks from startup through exit, throughout that full life cycle of running and hopefully exiting at some point a company. And we're really here today to talk about QSBS and the substantial opportunity that is available to founders to have extremely tax advantaged exits in the future for their companies. So with that, I would love to bring on Bob Dietz. And Bob, I'll turn it over to you.
Great. Thanks, Max. And good morning, everyone. Thank you for joining us. And as Max said, there is a significant benefit and value add if you get Section 1202 in qualified small business planning correct. Now, it's not just the founder that can benefit from this. It's also employees who might receive stock in compensation for some of the services that they're doing for the company. Also, investors who are just investing in the company can also benefit from the tax savings with qualified small business stock. In today's presentation, we're going to start by just walking through the value proposition. So what's the benefit? Why are we all here to listen to me speak about qualified small business stock? And then we'll spend some time on the basic requirements. And then we'll wrap up with some of the advanced planning techniques that can help you to optimize qualified small business stock. So just to begin here with the trade-offs and the benefits of qualified small business stock, what we're essentially talking about here is up to a $10 million exclusion from capital gains when you sell your stock or when you exit your company. So that can be a very significant tax savings, especially for a Minnesota-based taxpayer. So I'm showing on the right side of the page that the savings on a $10 million QSBS sale is about $3.4 million. So very significant. Now that applies as long as you purchase the stock after 9/27 of 2010. So there are some dates that we have to keep in mind, and I'll go through some other dates here in just a moment. But essentially what we're talking about is an amount of eligible gain that is the greater of $10 million per issuer or 10 times the aggregate basis, if your stock meets all of the qualifications I'm going to walk through here in a moment. Now, I mentioned that this 100% exclusion up to $10 million is available as long as the stock was acquired after September 27th of 2010. There's also a few other dates to keep in mind as well. So for stock that was acquired between February 18th, 2009 and September 27th, 2010, there's a 75% exclusion, and then that drops to a 50% exclusion from August 11th, 1993 through February 17th of 2009. If you purchased the stock or acquired the stock prior to that, it's not going to qualify for these benefits that we're going to be walking through today. So significant savings. Let me now focus in on some of the requirements. And I think it's important to be able to navigate through these requirements so that you know what you're dealing with and you know how to structure, whether it's your existing company or future companies, to try to maximize this benefit the best that you can. So first off, the first big requirement is this is for domestic C corporations only. So an S corporation is not going to qualify. An LLC or a partnership interest itself is not going to qualify either. And from an active trader business requirement, the corporation must have at least 80% of its assets in an active conduct of a qualified trader business. Now, the code doesn't list specific types of trade or businesses that are okay. Instead, it really applies it in the negative. So it says what businesses do not qualify. So service businesses generally do not qualify. Banking, insurance, leasing will not work. Investment management, farming, mining, oil and gas exploration, holding, hotels, motels, restaurants, any of those types of businesses will not qualify for this benefit, even if they are a C corporation. And then there's the gross asset test. So this is a small business benefit. So you have to have less than 50 million in gross assets at the time that the stock is being issued. So it doesn't matter if after you've issued the stock, the company becomes $1 billion corporation. That original stock that was issued, well, the company was still under a $50 million gross asset level, that still qualifies as qualified small business stock. So this is really about the original issuance of stock from the corporation, and the corporation has to have gross assets less than $50 million for that stock to qualify for this benefit. For qualified shareholders, there's a pretty long list that you can see here. So, of course, we have individuals can certainly be qualified shareholders, but also trusts and estates would qualify as well. And pass-through entities that own qualified small business stock also will qualify as long as the individual who is holding that pass-through entity is a qualified shareholder. Original issuance stock, as I was mentioning before, the qualified small business stock is created when the company is issuing common or preferred stock directly to investors. So this is not something that you can go out and purchase on a secondary exchange from someone. You have to either give the company your services as an employee or give the company cash or other property as an investment and receive stock back in exchange. There's also a holding period requirement that has to be satisfied. So it's a 5-year holding requirement. So you have to hold the stock for at least 5 years before you sell it in order to get this $10 million exclusion that we were talking about earlier. So just to drill down a little bit more on the active business requirement under 1202. So portfolio stock and securities. There are lots of corporations that we deal with that have portfolios of securities or other investments just as part of their operating cash flow. And you do need to be careful with this because a corporation will fail the active business requirement if over 10% of its asset value consists of stocks or other securities that are not a subsidy of the corporation. There is a working capital exception, which we'll talk about here in just a moment, but just know that there is an active business requirement here. And so you can't just simply hoard a bunch of investment assets in a C corporation and expect to get this $10 million exclusion. There's also a test for real estate as well. So the corporation will fail the active business requirement if over 10% of the assets are in real property that's not used in the qualified trader business. So really this will be like rental property. If I own a bunch of rental property as part of my corporation, that is not going to be qualified for these purposes. And then, as I mentioned before, there is a working capital exception, which you can see down at the bottom of the slide here. So the working capital exception is interesting because it allows you to maintain cash and securities and other liquid investments as long as it is reasonably expected to be used for working capital needs of the business. There's also, and I think this is very important in the medtech space or really in any other innovative type industry, there's an exception for funds that are being held to finance research or experimentation within a 2-year period after the corporation is formed. So after that 2-year period, then no more than 50% of the corporation's assets can qualify under this rule. So there is an important carve out for those companies that are looking to do a lot of research and experimentation in the early years. So let me pause there for a moment and check in with Max and see if we have any questions that have come in across the chat yet.
Yeah, Bob, nothing in the chat as of yet, but one question that I know has come up in previous discussions, which is, can you speak a little bit to how a company that originally raises capital through a safe round, right, fits into QSBS, since we know that that comes into play quite often with our med tech entrepreneurs?
Yeah, so it can be tricky with a safe investment because it's not entirely clear whether or not the IRS is going to treat it as equity. To the extent that the IRS treats it as equity, then it can certainly be treated as such. And so that 5-year holding period would start at that point. If it's not treated as equity, though, if it's treated as a prepaid forward or something like that, then the clock is not going to start ticking on that 5-year requirement until the safe converts into shares or equity in the company. And then also from a asset test level, that asset test will not kick in until that conversion occurs, until we actually have shares or what's deemed to be equity at that moment. So you do have to be careful with safe investments if you're trying to make sure that you're going to be eligible for this qualified small business stock.
Thanks, Bob. And one other question in the chat. The question is, does the $50 million limit practically mean that each round of financing should be less than $50 million?
So after you finish your financing round, it needs to be less than $50 million. So when you are forming your company and you're out raising funds, you want to make sure that with the last round of financing that you do prior to hitting that $50 million asset level, that you're coming in just short of that 50 million. And then you can certainly go out and raise more funds after that. But any stock that you issue after that final round at 50 million, anything above that is going to not qualify for this exclusion. But again, all the stock that was issued up to when you hit that $50 million mark, that is still qualified small business stock.
Thanks, Bob.
So let's talk a little bit more about original issuance. So oftentimes our clients are receiving options, restricted stock, or convertible debt instead of just pure stock. So a lot of this will come to employees who are receiving, in exchange for their services, oftentimes options and restricted stock. And so the real question is, when does the 5-year test begin? And when does the asset test begin for stock options? And the answer is, it starts upon exercise. So a stock option itself is not equity, and so we can't start the clock until we've exercised the stock options. At that point, we look at the corporation. Are the assets less than 50 million? If so, it passes that test. The 5-year clock then starts at that particular point. For restricted stock, it's either going to be the vesting date, or if an 83B election is made, we can also use the date at which that 83B election was made. So an 83B election for those who might not be familiar, is just a election that you can make typically within 30 days of being granted the restricted stock, which allows you to, for tax purposes, realize that restricted stock on its grant date versus when it vests in the future. So again, we can do vest date or we can do the 83B election. The 5-year clock begins on the date of that 83B election or the vesting date. Restricted stock units, it's going to be the vesting date, because with restricted stock units, you don't have the option to do the 83B election. So that's pretty straightforward. Again, 5-year clock will start upon vesting. And then convertible preferred stock, that's going to be upon the date of the investment. So preferred stock is considered equity for purposes of the qualified small business stock. So our 5-year clock will also start when that investment is made. And then convertible debt, it's going to be upon the conversion to equity. That's when we're going to look at the corporation to see, are we still under the $50 million level? And then also the 5-year clock will start running at that point. All right, so next up is qualified small business stock in pass-through entities. And this comes up quite a bit. We have a lot of clients who will own qualified small business stock through a trust or through a partnership or an LLC. And so these rules come into play quite often. But as I mentioned before, a pass-through entity can own qualified small business stock. That's not a problem as long as the individual who's the shareholder or has the interest in the pass-through entity, as long as they are a qualified shareholder. So the eligibility requirements are the exact same. A few additional pieces. Number one is that the stock needs to be held by that pass-through entity for more than 5 years. And the owner of the entity's interest has to have owned that interest when the stock was acquired and all times thereafter. So essentially what that means is I have to be a unit holder in the LLC. The LLC then goes out and purchases qualified small business stock as original issuance from the corporation. And then I have to continue to hold my LLC interest for a full 5 years in order for that qualified small business stock to qualify. So you can't simply kind of pass on through a partnership past that QSBS to different unit holders. So just keep that in mind. Also, down at the bottom, some very important traps, I think, for the weary would be, number one, what happens when qualified small business stock, which is owned by an individual, is transferred to a pass-through entity. This can jeopardize the qualified small business stock. So you can lose your status if you are transferring QSBS stock to a pass-through entity. So it's okay to take a distribution of QSBS from a partnership or an LLC, but when you contribute that in kind to the partnership or the LLC, that's when you potentially lose that QSBS status. So as I mentioned before, the bottom question is really dealing with what happens if an interest in a pass-through entity that acquires a QSBS is transferred. So if I transfer my interest in a LLC, for example, well, if I sell my interest to another person, then that sale is going to disqualify the QSBS. But if I just simply give my LLC interest as a gift to, say, another family member, for example, it should retain the QSBS status, and we should be able to tack on the holding period. So gifts should not be a problem when we're transferring qualified small business stock, and more on that in just a moment. Documentation requirements, another very important requirement. So under the code specifies that a qualified small business agrees to submit certain reports to the Secretary of Treasury and the IRS, and also shareholders. However, the IRS and the Treasury have not issued any regulations on documentation requirements. So as of right now, we don't have specifics as to what might need to be sent in if questioned by the IRS. So as kind of a best case scenario, what we should be doing is keeping track and keeping very clear and concise records of all of the transactions related to our qualified small business stock. So to the extent we ever have to show the history of where the stock came from, we can certainly be able to do that. So a few tips on record keeping to try to make sure that you are maximizing your chances for qualifying for the gain exclusion. So first off, keep clear records from the very beginning. So date of purchase, when did you purchase the stock? The amount you paid for it. Keep proof of how you paid for it, whether it was a check or a wire confirmation. The share certificates, having that also, and then have the company also provide you with certain documentation. So for example, we want proof that the corporation is a C corporation when you purchase the stock. We also want proof that the corporation has 50 million or less in assets immediately after you purchase the stock from the corporation. And then also you want a statement or other type of evidence that shows that the corporation, that its assets were at least 80% were used in active trade or business. And then, many of our clients will actually go out and get an opinion letter from a law firm that specializes in these types of transactions, just to provide that added level of comfort. But at the end of the day, it's really important to include experienced professionals, attorneys, tax professionals, financial planners that really understand these rules to make sure that you're not running afoul of any of the rules that we just discussed. Again, let me pause there and see if we have any questions from the chat.
Nothing currently in the chat, Bob, but let me ask just one more question if I can. So we're talking about, C Corp being the number one thing that needs to happen. So let's say that there is a startup that began as a different entity structure. Let's say it's an LLC.
Mm-hmm.
Do we throw out QSBS entirely, or are there workarounds for that type of an organization?
Yeah, and we're going to go through this in just a moment, but when you start a company as an LLC, you can and you have the ability to reorganize into a C corporation, and there can be some significant benefits to doing that. And we'll talk through that here in just a moment. I have an example, but in many cases, you're actually better off if you start out as an LLC and then in the future convert to a C corporation. There's a specific strategy that tries to maximize and leverage that $10 million exclusion to something much, much larger than 10 million. So we'll get to that here in just a moment. Redemptions is the other area you want to be really careful of, because redemptions, there are kind of two different types of redemptions, and they can cause issues both for the person who is redeeming the shares to the corporation, as well as in some cases, all of the shareholders. So for example, the first bullet there talks about a situation where a person is redeeming shares, but they're redeeming shares in a way in which it's not going to impact anyone other than the person redeeming the shares. The second bullet there is a situation where a significant portion, so a value exceeding 5% of the aggregate value of the company's stock that was issued or outstanding over a 2-year period occurs. If a redemption like that occurs, then you can be in a situation where QSBS is essentially lost for all of the shareholders. So even the shareholders who were not involved in the redemption. So you do want to be really careful about redemptions when you're trying to make sure that you're qualifying for this qualified small business stock exception. There are some exceptions down at the bottom. So redemptions that are due to, say, a termination of service. So if we have an employee who is leaving, who is terminated, there are some exceptions there. If there's death, disability, mental incompetency, or divorce, those can all be exceptions to these redemption rules. You just want to be really careful and make sure you're involving your legal counsel to review these transactions in advance. All right, so oftentimes we are in situations where our clients are shareholders in QSBS, but they've only been a shareholder for, say, 4 years or 3 years, and they get an opportunity to exit the company early at a significant multiple to what they thought they would be able to get. And so rather than trying to hold on for another year or two to try to get that maximum QSBS benefit, there is the ability to roll their qualified small business stock into new QSBS. And that's through Section 1045. It's kind of like a 1031 exchange. What you're essentially doing is within 60 days of the sale occurring, you're taking those proceeds or a portion of those proceeds, whatever you don't want to immediately pay taxes on, and you're investing in a new qualified small business company. So a company that is going to qualify for this QSBS under 1202. If you do that, there's no income taxes on the amount that's reinvested. And instead, it's going to just continue that clock. So if I did this at the 4-year mark, I only need to wait another year, and then I'm at that 5-year mark, and I can sell that new QSBS that I rolled into. So this can be a very flexible and attractive way to continue to extend that QSBS benefit. The other place this is very useful is if I'm selling a company for something greater than $10 million, and I have, again, that amount that's over the $10 million exclusion, instead of paying income taxes on that, I could simply just roll that into a new venture, a new QSBS venture within 60 days. And so for the serial entrepreneurs out there, this is a great strategy. Get ready to finance your new company after you're exiting your old company with proceeds from a QSBS rollover. So this can be very attractive. All right, so now let's talk about some of the planning strategies. And the first one we'll talk about is this LLC to C corporation conversion. Now, this can be a very attractive strategy, as I mentioned before, because we're able to leverage the 10 times basis instead of just relying on the $10 million exclusion. And so I'll walk through an example of that here, but oftentimes we see companies that are founded initially as an LLC, taxed as a partnership. You have the ability to, in the future, convert from an LLC to a C corporation. Now, when you do that conversion, so you convert to the C corporation, the 5-year clock starts once you've done that conversion, but also the basis for purposes of QSBS is the fair market value of the LLC upon the conversion. So number one, I have to convert before the LLC interest has more than 50 million in assets. And number two, if I convert when the value of the LLC interest is more than $1 million, then I'm able to exclude from capital gain tax something in excess of $10 million. Because as I mentioned before, the exclusion is you can exclude the greater of $10 million or 10 times basis. So if my LLC interest is valued at $2 million when I do the conversion, then I can do 10 times my $2 million basis and exclude $20 million total. So a very, I think, easy way to create additional exclusion is through this LLC to C Corp conversion. It's a tax-free conversion, which means that we don't pay any income tax when we go from the LLC to the C corporation. But when we finally do sell our shares in the future, yes, we get to exclude that $20 million, like I was saying in my example, but we do still have to pay capital gain tax on that $2 million of basis that was originally created. But again, you're still much better off because you got an additional $8 million excluded in my example. So let's look at an example and just kind of compare an LLC to C Corp conversion to simply just starting as a C Corp. And then we'll also look at it compared to a stock that does not qualify for the exclusion at all. So the founder here establishes an LLC with an initial investment of $100,000. 2 years later, they look to convert from an LLC to a C corporation. At the time of conversion, the fair market value is now $8 million. So not the asset value necessarily, but the fair market value is $8 million. And then 5 years after that conversion, they sell the corporation for either 25 million on the far left there, or 50 million, or 75 or 100 million. And now we're comparing three different alternatives. So the blue bar is the LLC to C Corp conversion. The middle bar is if we started as a C Corp all along and qualified for that $10 million QSBS exclusion. And then the purple bar is a stock that would not qualify for the exclusion at all. What you'll notice is that for the blue bar, the LLC to C Corp, the tax liability is the same if we convert 25, 50, or 75, or excuse me, if we sell at 25, 50, or 75, the tax liability is the same at 2.7 million because we're only paying income taxes on the basis, the $8 million of basis. When we go to the $100 million sales scenario, though, now we're paying not just on the basis, the $8 million of basis, but we're also paying some additional capital gain on any amount above $80 million because 80 million is the amount that we get to exclude from capital gains under this 10 times basis rule. So you can see it's a very effective way to reduce the income tax liability on the sale of the C Corp stock. Again, this is where we're starting as an LLC and then converting to a C Corp. The next strategy is QSBS stacking. And this comes up quite a bit for clients because oftentimes they're not thinking about this LLC to C Corp conversion. They're focused on running and building their business. The QSBS stacking, as long as we're getting ahead of the transaction where they're exiting the business, as long as we're getting ahead of that, for a sufficient amount of time, we can do a lot with QSBS stacking. And what we're referring to when we say QSBS stacking is we're essentially creating additional taxpayers to get additional $10 million exclusions. So we know that I, as the owner of the stock, will get a $10 million exclusion. But if I were to transfer $10 million by gift to, say, my kids, my child would also get a $10 million exclusion. So now we have 20 million being excluded from capital gains. Of course, the issue with that is now my kid has $10 million and I may not want that to occur. So I may instead want to do this to a trust. And so it's possible to create a trust for these beneficiaries, structured as what's called a non-grantor trust. As a non-grantor trust, it means that the trust is a separate income tax payer. And so the trust will file its own income tax return. The trust will pay its own income taxes from the assets in the trust. And so as a result of being a separate taxpayer, if I transfer $10 million of QSBS stock into that trust and it's sold, that trust will get its own $10 million exclusion. So oftentimes we're seeing families that will structure the stacking using these non-grantor trusts. And again, the idea is to make sure that the assets are not just directly going into the hands of children or grandchildren and that sort of thing. You can also see on the right side of the page, there's a few other options you can consider. So there's family members, like we talked about. There's the non-grantor trust, and there's a few different flavors of non-grantor trust. So I could create a self-settled non-grantor trust where I am the grantor of the trust. I put the $10 million into the trust. It's still part of my estate for estate tax purposes, but it's a separate income taxpayer. So I'm getting that $10 million exclusion. However, because I'm also the beneficiary of the trust, the trustee could make distributions back to me in the future. So this is a way for me to be able to capture that additional $10 million exclusion without giving away those assets completely, since I can get distributions from that trust under certain standards. Let me pause there before I go any further and see if there's any additional questions.
Yep, Bob, we've got a few questions in the chat. The first one, how is the fair market value of the LLC at conversion determined?
Yeah, it's appraised. So you're going to have to pay someone, most likely, to come in and do a full valuation of the company.
So the next one, can you reinvest into the same venture with the 1045 exchange or 1031?
So with the 1045, you can. The problem is if you're doing that, you are not going to be able to get an additional $10 million exclusion, because that $10 million exclusion is per issuer. So I can only go up to 10 million with that single issuer. So you're probably better off investing into another separate venture that would be considered a separate issuer.
And then the third question. So how does QSBS qualification work in the instance of an investment into a company which has raised more than $50 million in equity, but has over time consumed those assets and then written them off? And so here's a example. Company has raised $70 million over several rounds to invest into an asset. That asset has been discontinued and written off to zero. The company continues to operate, raising money for a new opportunity. Would a future investment of $10 million be eligible for QSBS status, assuming the other criteria has been met?
So not necessarily. I think there are some ways to structure this to kind of get to the result that you're trying to get to, but I don't think it's going to be as easy as just simply issuing more stock now that the value of the assets have dropped back below 50 million. There's going to be some additional work that has to be done. So it's a little bit more complex, but I think you can probably get to where you want to go, again, through some additional structuring that you'd have to do.
Perfect. Thanks, Bob.
Absolutely. So again, the first issue was I don't necessarily want my kids to have direct access to the funds. So I use that non-grantor trust. But the second issue with this stacking is how much can I afford to give away, and how much of these proceeds do I need to retain for my own lifestyle and personal spending needs? And so we always start with core and surplus for our clients, which is really focused on establishing how much wealth do they need at an investment allocation that makes sense to them in order to ensure that their lifestyle spending is going to be met for the rest of their lives. And this is done at a very conservative modeling. So we're assuming poor capital markets, high inflation, and a lifestyle or a term or a time horizon that's much longer than the mortality tables suggest. And once we've calculated that core portfolio, then really anything left on the balance sheet, that's surplus capital, and that would be the assets available to potentially transfer through some of these more advanced strategies. And you can see on the right side of the page that we're expecting core capital will decline over time because you have fewer years ahead of you. And so we would expect that surplus capital to start to grow over time. So this is not necessarily a static model, but just to give you a sense of the core capital numbers today, here we're looking at a grid that shows on the top the sustainable spending rate. So how much can I spend from my portfolio at different mixes of stocks and bonds, with all bonds on the far left and all stocks on the far right? How much can I spend from my portfolio? This is the percentage of the beginning portfolio value, and then growing that value each year by inflation. And we're looking at that for a 55-year-old, a 65-year-old, and a 75-year-old. So if I just assume I have a 55-year-old who's invested in 60 stock, 40 bonds, you're looking at about a 2.4% spending rate. If I'm spending less than this 2.4%, it means I'm going to have surplus capital that I potentially could put towards some of these stacking strategies that we mentioned. If my spending rate's above 2.4, it's not necessarily mean I'm going to be in trouble. It just simply means I shouldn't be looking to transfer large amounts of wealth through some of these strategies. Down at the bottom, we're looking at the portfolio size, so the core capital required per $100,000 of spending. And again, if I'm a 55-year-old with a 60 stock, 40 bond portfolio, I need about 4.2 million for every $100,000 that I want to spend from the portfolio. And so I would want to make sure that I have at least 4.2 million before I start to engage in some of these more advanced stacking techniques that we're going to walk through next. So here's a case study for a 60-year-old married couple. they're looking at selling their C corporation for $50 million pre-tax. Their after-tax spending is $300,000 per year, growing with inflation. Now, the couple knows that this is eligible for the QSBS exclusion under Section 1202. So they know they're going to get at least a $10 million exclusion if they sell their company because they've held it for at least 5 years. So they're looking at savings of around 2.4 million in taxes because they're not Minnesota residents, they're Florida or Texas residents. So just federal capital gain tax now would be affecting this particular couple. The goal of this couple is to completely eliminate income taxes on this $50 million sale. And there's a few ways that they might go about doing that. So we know, first off, that they're going to be able to exclude at least $10 million. So that's our first scenario. Our second scenario assumes they transfer $10 million to a self-settled, incomplete, non-grantor trust, which essentially means a trust that is still part of their estate for estate tax purposes. So our grantor is moving $10 million into the trust. The trust is a separate income tax payer, but it's still part of their estate for estate tax purposes. So it does not use any of their $13.99 million estate or gift tax applicable exclusion. So they do have access to the funds. A trustee or a distribution committee can make distributions back to the grantor as needed over time. And since it is a separate taxpayer, it's going to be responsible for filing its own income tax return and paying its own income taxes. So that's an incomplete non-grantor trust. Incomplete means we did not complete the gift. It's still part of our estate. Scenario C is another $10 million incomplete non-grantor trust, this time set up for the spouse's benefit. So we're doing a trust for each of the spouses separately. And then we have, in scenario D, a $10 million completed gift non-grantor trust for their descendants. And this will be future generations, kids and grandkids and that sort of thing. Now, this trust is outside of the estate. It means that the grantor has irrevocably given away these assets. The grantor cannot get these assets back. So it did require the use of at least $10 million of their applicable exclusion to get the assets moved into the trust. The trust, again, is going to be paying its own income taxes, filing its own income tax return, and so it will qualify for a separate $10 million exclusion. We're also going to do this again for the spouse. So each spouse essentially funds one of these completed gift non-grantor trusts. And when we put it all together for the couple, what we can see is we're able to reduce their income tax liability from 9.5 million in scenario A all the way down to zero on this $50 million sale because we're taking advantage of these multiple exclusions. Now, important for this couple is their spending rate of $300,000. So we want to make sure that we're not jeopardizing their spending. If we look at all of the various buckets on the right side of the page, the couple is going to be able to spend from this 30 million here. So the 20 million between the two trusts for the spouses, and then the 10 million that they retained personally. Now, some practitioners will take the opinion that each spouse gets their own $10 million exclusion. So, for example, scenario A would be 20 million because we have a married couple instead of 10 million. But that is not necessarily a safe assumption. There's some controversy around that. So I would just make sure that if you are going down that path, that you get a legal opinion, that you sit down with a competent tax attorney to review the risks of taking positions like that. But it certainly is something that we've seen many times before. So again, stacking can be a very effective way to really leverage the exclusion, and you can create, many different taxpayers through these structures. But what you can't do is create identical versions of the same trust. So I have to have a different beneficiary, a different grantor on the trust. If I just create the same almost carbon copy of the trust many different times, the IRS will collapse those trusts into one single trust. So that's why we do need to have a different beneficiary and a different grantor on each of those trusts. Okay, so in conclusion, the QSBS exclusion is incredibly valuable for founders, and not just founders, as we said before, investors and their employees as well, who are investing in these emerging companies. But you do need to take great care when you are navigating the rules. And so make sure you have competent professionals that you're working with who can help you to navigate the ins and outs, both from a legal perspective, but also from a personal financial perspective as well. And so with that, I will turn it back over to Tom and Max and see if there's any additional questions.
Yep, just one last question before we start our wrap up here, Bob. So does the initial company equity have to be in both spouses' names to gift it into two separate trusts without it counting towards the gift exclusion?
Yeah, so you would need to, typically you would want to split that up. And so you would put 10 million into each spouse's name, and you would want to do that in advance of actually making the gift. So oftentimes we'll see married couples who might have the company in joint names, or it's all in one spouse's name. What we need to do is we need to separate that so that each spouse has their own $10 million. And then after some time has went by, so we've created some economic reality, then the spouses will look to make that $10 million gift at that point.
Got it. So to summarize, it does not have to be at the initial issuance of the stock. It just needs to be in advance of the funding of the trusts.
That's right.
Perfect. Tom, we'll turn it over to you.
Yeah, great. Well, thanks, Bob. And we wanted to thank Frank and the AVO team. They're an invaluable resource to this community. And of course, that's one of the reasons you're here. As Max mentioned, at Bernstein, we have a lot of research and time spent helping founders in the medtech space throughout the life cycle of their business. So out of today, we've got some research available to you and are happy to set a time to meet if that makes sense. If you're interested in that research or scheduling a conversation, you can get our contact information from Frank. So thank you all again for joining and have a great day.
And I see one more pretty good question there in the chat.
You beat me to it.
Coming at the last moment here.
Bob, what happens if a large strategic acquires a QSBS qualified C Corp before the 5-year mark?
Yep. So you can roll the QSBS into, kind of like we were saying before, through the 1045 rollover. So you can roll it into a new QSBS company. If the strategic is QSBS on its own, then you potentially could just roll into that existing company. So it's not necessarily the end of the road and you're going to lose the benefit simply because you're selling 4 years into the 5-year time window, but you do need to do some additional planning prior to the transaction to ensure you have that property to roll into.
If the strategic wasn't qualified, then what would happen?
Yeah, so if the strategic wasn't qualified, we would need to find one that is qualified to roll into.
Very good to know. And I think that is a great place to wrap it up. Bob, thank you so much. Max and Tom, thank you guys for being great partners. Folks, this was recorded. We'll have the transcript and all that ready pretty quick. And please do reach out to the Bernstein folks if you got other questions. They are great partners to the startup community. Enjoy the rest of your Monday.
Thanks, Frank.